So let's talk about life insurance and general insurance companies, which are the two largest types of insurance companies. So what is insurance? Well, insurance is about transferring a risk you're exposed to another entity that can pool these risks together and then provide payment if a loss occurs. So for example, you might take out a car insurance policy that protects you against the cost of fixing a car or a building if you were to have an accident. So let's say you crash your car into a building and you have comprehensive car insurance, then that insurance company will pay for the damages. Now, if you think of it from the point of view of an insurance company, these losses can be very, very unpredictable. And an example of that is what's happening with climate change and whether or not weather patterns are changing. If we have more extreme storms, that might create more damage, hail damage for cars or storm damage to houses. So these losses can be unpredictable for that reason. So let's look at life insurance companies now. Obviously, life insurance companies sell life insurance as well as superannuation policies. Where do they get their money from? Well, if I have a life insurance policy, I will pay a premium to the life insurance company. And let's say, for example, if it's life insurance and I die, then they would pay a benefit to my estate. They also get money from superannuation contributions. There are different types of life insurance policies, and the types of life insurance policies that exist relate to death. So if I die, a payment is made. It might be permanent disablement. So if I'm disabled, a payment might be made. Trauma or income protection if I get sick. These are all different types of examples of the types of insurance policies offered by life insurance companies. So what do life insurance companies do with the money that they receive? Well, because the outflow of funds is more predictable than it is for general insurance companies, they invest mainly in longer term securities such as equities and unit trusts. However, they also do have cash and short-term investments to meet ongoing payments as they fall due. They're supervised by APRA, and the Life Insurance Act is the legislation that licenses and controls life insurance companies. General insurance companies insure against different risks compared to life insurance companies. So for example, general insurance companies commonly insure against damages to motor vehicles or house and contents. Where do general insurance companies get their money from? Well, from customers paying their premiums periodically to protect against damage to a house and contents or motor vehicles. There are different types of motor vehicle insurances that cover against different risks associated with driving a car. And the inflow of funds for a general insurance company is not as stable as it is for a life insurance company. So because of that, what do general insurance companies do with their money? Well, given that the risks that they underwrite are less predictable in nature, they hold a much higher proportion of short-term securities that they can turn into cash more quickly. So for example, money market securities such as bills of exchange, commercial paper or certificates of deposit. And the share of total assets for them has declined. Now we're going to have a look at finance companies and general financiers. Let's have a look at finance companies now. Finance companies are not authorized deposit-taking institutions, so they can't get money from deposits. So what they might do, for example, is issue a security in a domestic or an international financial market, and with that money, they make loans to small business and individuals. And they emerge largely because of the restrictions that were placed on banks with respect to interest rates. And this sector, this finance sector, can be classified into diversified finance companies that are manufacturer affiliated, as well as niche specialists. So for example, a specialist finance company that deals only with motor vehicle lease financing. So where do finance companies get their money from? As we said before, they can't get it from deposits. So what they might do is issue a security into the domestic or international money or capital markets, an example of which is issuing a debenture or an unsecured note, which is an example of issuing a security into the capital markets, which is the longer term market, or they might borrow from related corporations. And what they do with their money is they give loans to individuals. They might be higher risk, charging them a higher rate of interest. They provide lease financing as well as loans to small and medium-sized business.